Hello, everyone. It is April 3rd. It is Thursday. It is the day after the big tariff news was announced. It was announced after the market closed, and I think the administration that announced them knew that it was going to create a lot of angst, a lot of concern, and cause stock prices to really sell off, which has been the case. The Nasdaq's down 4.4%. The S&P's down 3.69%. The Dow's down 3%. It's a pretty brutal open that I expect. There's plenty of fear out there, and the fear is really I think it's well founded. As you look at tariffs, what are tariffs going to accomplish in the long run? They may accomplish something. I would admit that hey, for all I know, policies broken between countries. And maybe over the next 10 years, that policy is going to improve. Okay. But I'm a stock investor. And for 2025, what's going to happen? Well, my expectation is that stock prices are going to go down. We're going to have a similar but different year as we had in 2022, where stocks are going to go down. And they're going to go down probably another 10, 15% from where we're at the moment. Of course, we're going to go down on the NASDAQ more than 4% just in the open. So things are going to get pretty nasty. The reasons I say that is, so first, some sectors like consumer discretionary, and I'll show that later, are just getting turned upside down. If you look at the apparel industry, it does most of its manufacturing in low labor markets like China. And automotive ought to be okay. They were already dealing with, I think, a lack of demand. But there's just a lot of industries that are going to be turned upside down. Their cost of doing business is going to go up very quickly. So I think that's going to show itself in the earnings we have that are going to start in 2 weeks. So these companies, if they come out, with the pom-poms out, really enthusiastic and so forth, it'll be a giant surprise to me. Instead, they're going to come out and say, hey, this is what we're doing to be disciplined and operate the business and manage the business well. But we have plenty of headwinds. We have plenty of things to deal with. They're probably going to guide down. Earnings will probably be less than desirable for this round. Like the earnings that are going to be announced here toward the second half of April, I'm expecting earnings are going to be depressed. And that's going to cause another wave of sell-offs. If you have big caps announcing, we're going to lose demand in Asia, China being the biggest consumer out there, we're going to lose demand here, we're going to lose demand there, that's going to really show up in earnings, and earnings are going to move stocks. So that's part of it. The other part is a recession. The recession is pretty much set. If you have a shock in the economy. Now, my education, I have a business degree with an emphasis on accounting, and I have a master's in business, and I have a little over 30 years of business experience. And economically, I took enough economics courses to know, economic, I think, philosophy, and this is a shock to the economy. And the shock is that if you think about businesses, they're going to be at least a couple months, if not 6 months, of indecision. Indecision leads to, let's not buy that capital equipment. Let's not expand. Let's play it safe. Let's not hire people for the immediate term. And that indecision is going to play out in the economy, and we're going to head into a recession. All of these things, of course, shouldn't be completely a surprise. I think we were talking about a recession for a while. If you watch this channel, you know that I've been talking about a recession. and that I felt that we were heading towards it. Well, yesterday and really the last 24 hours, we took a nice leap toward that recession. So that's what's going on. If you're new to my channel, it's great to see so many subscribers on. I understand today's a very concerning day. This channel, I focus on long-term investing. I focus on finding companies that are discounted price below their intrinsic value calculated by looking at the future cash flows of a business, which is the truest sense of the value of that business. And that's what I strive to do, getting better each month, each year, and making more money each year. As we see this market that's selling off, it's going to create better prices for investors. And the trick right now is having enough dry powder to go out and buy these stocks. And I'm a dollar cost average guy. And, at times, and, the attendees that attend my live streams and have been attending my live streams for a long time, I appreciate that very much. But you heard me saying toward the end of 2024 and at the beginning of 2025 that the market was just too expensive. It was euphoric. I actually sold positions in late 2024 to create cash. I just wanted a bigger cash pile, and I built that cash pile. I don't think I built it big enough to deal with days like this where the NASDAQ's going down 4.5. So I'll probably maybe begin to get light on cash at the end of April, maybe in May. So I'm already trying to figure out where can I get more cash? And it's probably going to come out of my bond portfolio. I have a bond portfolio and I can easily liquidate, I think, the next pile that I'll need of cash. How long is this thing going to play out for? I don't know. I'm just hoping that it's not longer than 6 months, because I think after 6 months, I think it'll really be depressing. But the prices will be great. We'll take a look at some stocks today. Most definitely, there's going to be some interesting pricing out there today. And I'm a dollar cost average guy, so I'm going to be buying shares today. Important thing, what's cool about YouTube is we could talk about what's going on and we can keep our wits. Okay. We need to keep our minds on all rational, logical thinking. The market is discounting stocks. That's great. We need to separate noise from information. Information's good. It helps us assess, is the forward 12 months for this industry going to be bad because of the information I just heard? That's good. But the whole emotional baggage that comes along with information at times, it's my preference to ignore it. Just ignore it. I don't want to process that. I want to process the information. Give me information that tells me how's my meta stock going to be impacted. Don't give me the whole, emotional baggage that comes along with that, because it's going to get pretty damn ugly really fast. All right. So I've got some opening slides and then we're going to look at the markets. I have some stocks that I wanted to talk about. I already have a member request from Tomas who wants to look at Adobe. Glad to do that. It's good to see Tomas on. Shadow Guy. I've been communicating with Shadow Guy on Discord pretty much late into last night and early into today. Good to see you. Box for Fun, thanks so much for joining. Barrelite. Tomas Blinos, very good to see you. Do Me Trash, what's up, buddy? It is the day after tomorrow. Sabir too, very good to see you. Thank you very much for joining. And if you would like to put either a topic or a stock that you want to talk about, please do so. And if you would like just one note is, it's going to take me a little while to get through my opening remarks. I have some stocks I wanted to cover. I'm going to cover a member request. Those are always the priority since they pay to be members, and I'd like to show my appreciation for that, for sponsoring the channel. If you have a request out there and you're a free viewer, it might take a little while for me to get that to that request. So please bear with me, and thank you for attending. So the fear and greed index is at 22, and I think this thing's going to move. Probably, it's going to move down, meaning that there's more extreme fear. It's just logical, right? I think yesterday's news is creating a huge news cycle, and there's a lot of concern. There'll be a lot of examples of how these tariffs are really hurting particular industries and companies. Now, when we look at this is the stages of a bubble, and boy, we were just humming along. The election came, and man, stocks were just going crazy. And I'm going to pick on Robinhood because that's one of my holdings. It was euphoric. Oh man, Robinhood's just flying up, and boom, we started to sell off, and we started to sell off prior to this whole, tariff war announcement. And now I think we're probably on the way down, and we're coming down fast, man. Boy, it really, this chart is somewhat accurate on how quickly we're going down, especially today. So maybe I would move this line after today. I'm going to move it down a little bit. But this is kind of like the roller coaster ride that we're going to ride. And as we go through this, stock prices continue to get more and more attractive for the long-term investor. And that's definitely going to be the case on this turnaround. When I look at the sectors, and of course, all stocks fit into a sector, there's 11 of them. And I put out there what I think is, the tariffs. Are they going to hurt that sector? Are they going to help that sector? And this is what I'm seeing is energy. I'm not quite sure. Something tells me that when you have a tariff war and prices go up, if commodity prices for energy go up, the energy companies win. They make more money. Now, the immediate response to the tariffs in oil prices is oil prices were down quite a bit. So I'm not quite sure. Materials, they're going to go up. Material costs are going to go up. I like the material mining companies. Gold is going up. All these things are going up. So they're probably the material stocks are probably going to do well going forward. Utilities, I don't know. I don't like utility stocks, so maybe that's part of my impression there. Consumer staples are going to do well. We're going into recession. People are going to start watching their budgets. Financials, I think, is going to be neutral. Like some are going to win, some are going to lose. Insurance companies, they're going to win. But some companies that are dependent on that consumer, they're going to lose because the consumer is going to have less purchasing power. They're probably going to watch their money and so forth. Healthcare, I think, is going to win. Healthcare isn't going to deal with too many tariffs. And I think healthcare is going to do well. Real estate, I think, is going to do well. Interest rates are dropping fast. I've got a next slide showing that interest rates are dropping. As interest rates drop, so that'll make housing more affordable. It'll make making project deals better. And that, I think, is going to happen. Industrials are going to get smashed. So we already see that, like, shipping stocks have been coming up a lot, and shipping stocks are going to get crushed. In fact, I should take a look at Zim or one of those shipping stocks to see what's doing today. But I think there's just going to be fewer voyages, or the ships aren't going to be as full. And if you look at UPS, FedEx, they're already getting smashed, but they're going to get further smashed. I mean, if you're going to have tariffs, you're going to have less, theoretically, you're going to have more localized sourcing as opposed to international sourcing that requires a lot of freight, as well as all the industrial companies that actually create products and are, creating products to feed an economy that's growing. Well, the economy, I don't think, is going to grow. So I think industrials are going to get smashed. Communication services, I think it's, some are going to win, some are going to lose. Discretionary is going to get destroyed. It's already getting destroyed. I'm going to show a couple of stocks that are in consumer discretionary, like Nike, getting destroyed today. And technology is going to go down. If you think about Apple, it's getting destroyed today, as well as any type of consumer technology. It all gets manufactured in China. And you have Taiwan was on the list, but I don't think Taiwan's going to get all angry at the United States because they really need us. But all the semiconductors are manufactured in Taiwan, or most of them. So there's just a lot of technology tied to Asia. And if you get in a big, war with Asia or China specifically around tariffs, it's going to really hurt technology. So some sectors are going to benefit, some are going to lose, and that's how I see it there. The recession's coming. This is announced a month ago that the Atlanta Fed is forecasting a recession, and they're going to start seeing it. We're going to start seeing it now, because this was prediction for the first quarter of 2025. We already started the second quarter of 2025, and this measure will be released probably toward the end of April. Well, if we're already measuring that we're in a recession and we just had this, big shock in the economy of these tariffs, it's for sure going to be a recession. Psychologically, that's going to have a big impact on the stock market. So those are the quick opening remarks around slides. But Shadow Guy, you want to look at TLT. That'll be the first one I look at here. And you are right that the TLT is up 1.4%. What's TLT? It's the 20 plus year Treasury bond ETF. So as you see stocks getting crushed, like they're getting crushed today, bonds really stand up tall, because bonds are the place where investors, especially big money investors, when they get out of stocks, they want to put their money where it'll earn a yield, and they go to bonds. And long-term bonds have a decent yield right now, and those yields are dropping very quickly. And this ETF that really holds these long-term bonds is up 1.43%. So all my bonds in my portfolio, I have a bond fund. It's going to do really well today, but it's nowhere near the amount of losses that I'll have in my stocks. I expect there's going to be big losses on my stocks. So the TLT, getting it done. Just to examine the TLT quickly, what's in that TLT? Let me take a quick peek. So it holds all these treasuries. See how they're dated here? This one's going to redeem in 2051 and so forth. And this is what it holds. And it's a very safe investment. On a day like this, it looks pretty genius. It's, as you manage your wealth, as you manage your stocks and your wealth and your overall wealth being, if you own real estate, that's part of your net worth. If you own stocks, obviously, that's part of your net worth. Crypto, bonds, gold, those types of things, assets that you could easily sell, redeem, I consider in my net worth. Well, bonds to me are the part of my net worth that is liquid. And when things go really bad, I can really depend on that part of my portfolio to keep its value. And in this case here, appreciate some, and I could tap into it. And that's exactly what I'm doing going forward. Is I have these bonds. They're going to go up in value a bit. And as these stocks keep getting better and better priced, I'm going to tap into that bond portfolio. I'm going to tap into it and grab some of that cash and put it into stocks. Now that's like my next 3 months of planning. Got to keep on the right path here, which is, if we look at 2022 and we look at the NASDAQ, 2022 was played out far slower than what we're dealing with here. Like this year, we are on a really steep decline. But in 2022, the NASDAQ went down 35%. And it was frustrating at times. We had bear market rallies that seemed to, is this the time when we're going to get out of this stinking down market? But at this time, stocks like Meta is the perfect example. I never, for 1 second during that period, I never thought Meta was a bad company. I thought it was a great company. During that time, the metaverse was kind of being criticized quite a bit. The price was reduced by 76% on Meta. Unimaginable. I bought shares. I continue to buy shares. I bought shares throughout 2022, believing that this market will turn around at some point. Meta is a business that I want to be an owner in. Thank you for the discount. It wasn't fun to see stocks go that way. But what was superbly fun is to watch the rebound in Meta, up 711% from its lowest point. That's what we're dealing with. Okay. And if we look at year to date, Meta certainly showed its value because, I believe Meta has just a terrific business. A lot of things going in the right direction. The market was really roaring and it was probably overdone. But you look at the decline in Meta over just about, we're coming up on 2 months. It's down 21%. It's probably going to be down. It's down 6% today. That is a big beatdown on a day like this. Well, it's a good day to maybe buy into Meta. It's a good day generally to buy into some of these companies because Meta, what changed in the last 24 hours? Did Meta become worse? No, same company. They have a bright future. I love their Meta AI business. It's just a net positive that could happen for the company. There's a lot of things that Meta has impressive value around. They have huge moats, huge competitive advantages. They generate so much darn profit and free cash flow that, hey, you want to discount it by 6%? I'll take some of those shares. Thank you very much. And across the board, I'm going to be buying, which is why I'm going to run out of cash quickly. Is if I start buying across the board, it's going to be, I'm going to run out of cash. And that's all right. That's all right. If I put that money to work, we just saw what Meta did from 2022 to its peak. It was up more than 700%. So I will gladly put my capital to work at the right times. So the TLT is getting it done today. It's a bond portfolio. And I know that I'm sure everybody tuning in is a stock investor. But just keep in mind, especially as you get older, you want to get good at understanding bonds, understanding assets that are going to, maybe like the way I like to see it is I put the money that my family needs for the next 5 years in bonds. Then our standard of living doesn't go up or down based on the stock market. Like today, market's going down. I don't want to go to my wife and say, sorry, honey, we're going to have to hit the peanut butter and jelly and the macaroni and cheese for a while and not spend any money. It's like, you know what? This is going to be a temporary thing. Let's keep rolling. And I got summer plans with my family. We're still going to do that. It's going to be fun. And I'm going to still spend the money I expected to spend this year. And that's because it's all in the bond fund. No problem. Next 5 years are covered. All my expenses. And that's why I do it, is I just don't want to put my back against the wall. And that's what I do. All right. So that's the TLT. Let me take a look at Adobe, which is a request from one of our members here. Let's take a look at what Adobe is going to open at. Adobe, I believe, is discounted. It's going to be down 3.39. It's not probably the worst that we've seen. I'm going to show you some consumer discretionary stocks that'll make this look like it's actually a positive not to go down so much. But this stock's been really sold off. And it's the big scare that, hey, AI is going to disrupt Adobe, that AI is going to be able to create all these images that people want to have. And I understand the story. I don't believe the story. I don't think that's going to happen. I think that people that use Adobe are going to continue to use it because it's the right tool to do the right job. And in the space that they sell into, it just keeps getting bigger. You look at online, right? As you see all the graphic designs and work being done online, that just keeps expanding. So, in my opinion, that story is, from my perspective, it's kind of a false narrative or incorrect narrative. I think Adobe is going to be fine. When we look at their fundamentals, um, Adobe fundamentals are what convinced me that the company is fine because they keep growing. Well, if AI is so great and is, everybody's going there to create images, well, why does Adobe's revenue keep growing? It should be the opposite. Oh no, Adobe's revenues are going down because AI's, and the reality is AI does it at times a poor job. Like if you use AI, you know what I mean. If you want written responses, it does an okay job, but study what you're getting. I mean, I try to use AI, especially for stock analysis, and a lot of its data is either overly summarized, incorrect, or too old. All those, I mean, I'm not going to trade on stocks with 2-year-old data. It's like, no, I need data that's like 20 seconds years old, 20 seconds old. Um, Adobe continues to grow. They continue to attract more customers. That's very good. But this story out there, and I think the AI story is beginning to kind of get old. It's already gotten old. I think the word's out that, hey, maybe the market overreacted to this whole AI thing. And I think over time, AI is going to continue to show up, but it's not going to be like, oh, it's going to replace everything. No, not immediately. Maybe in 20 years, we might wake up to a scene out of Terminator where all the machines are running the place, or the Matrix. But for now, for the next 5 years, I think it's going to be close to what we have today. Systems keep getting better, and AI makes them a little better. In the meantime, our friends at Adobe just keep growing their free cash flow. Beautiful free cash flow growth. What's there not to like about that, folks? Free cash flow, the principal element of value for a company. Adobe keeps growing it because look at these margins, 89% gross margins. That's the software space. And they sell their software as a subscription. So if somebody decides I'm not going to pay my subscription, they don't get access to the software. So they can't create the graphic arts or the videos or whatever they use Adobe for. They can't use it anymore. So it's a very strong moat because you have that network effect, and people are going to continue to pay the subscription, and companies will pay the subscription. Adobe also operates a pretty strong e-commerce business. They acquired a business some time ago that competes with Shopify. It's a very good business. They also started a business that wants to compete against DocuSign, and they're trying to grow organically. So I think Adobe's a terrific company. I think it's misunderstood and presently discounted. When I look at the discounts on Adobe, it's a pretty good discount. Of course, today, the discounts are going to get even better. So I think based on cash, the stock's discounted by 64%. When I look at a cash forecast for the company and I reduce that cash, I do a net present value calculation on that cash flow to today's value, I get a 64% discount. This is a quality company, by the way. Adobe has an awesome balance sheet, very strong. Most people know Adobe. I've known Adobe for a long time. It's a strong company. So this is a winner all day long. I'm a buyer. I own the stock. Adobe's a good one. So that is for you, Tomas. Hopefully you're having a good day. Mike, the dividend investor guy. You're adding Adobe on the dips. Very good. You sold your Nice a while back, and you might be buying back. So Nice is going up and down today, huh? Shadow guy. Nice is down today, although they're done well lately. Am I concerned? Let's take a look. There's a I thought about this software company in this context, which is a good thing for Nice. So Nice is a smaller company, 9.8 billion. They really operate in the whole CRM, customer experience, call center software space. And again, the AI story that, hey, software companies like these are going to get completely replaced is completely overdone. It's not. We're not going to, like, as consumers, we're not going to put up with just constant chatbots that don't get us the answers we need. If you are calling in, let's say healthcare related, you're calling into your healthcare provider, and they have to give you good answers because and a human being has to talk to you because that information is really important. Or if you bought a product, you're going to have a bad experience if you go to get service on that product, but all you do is deal with chatbots and never really get you the answer, and you waste a bunch of time. You're going to really have a negative impression about that company and share it online. So companies will continue to use Nice software to give their customers a good experience when they call in for service, because that's predominantly what they do. They have software for call centers, and they're also developing AI applications that will enable customers to deflect a lot of the calls away from the call center and into an AI experience. Their forward PE is 12. And again, the big story is, AI is going to destroy the Nice business. It's probably already destroying it. So when we look at the growth, no, it's not. These guys keep growing. Again, the story is partially, I don't even know if they have any facts behind the story. Theoretically, they theorized, hey, AI is going to replace companies like this. I get it, but that's more imagination. That's more of, hey, we're imagining that's going to happen. Well, the facts don't line up with that story. The facts tell me a different logical, factual story, which is this company keeps growing. So this is a strong business, growing 15%. Free cash flow keeps growing. So a business that's supposed to be being disrupted is growing top line revenue, is growing free cash flow, has gross margins of 67%. I'm not seeing the disruption. So that story is kind of a illogical story. The data and the facts support that Nice is a growing business. Now, the reason I thought about Nice is we have this tariff war. And we are charging tariffs on a lot of countries and regions that for a long time, things were quite pleasant and friendly with Europe. I can't say that they were as pleasant with Asia. I think there's been tension there. But we are creating a lot of tension around the world. And one of the most important sectors and industries that we have in the United States is software. Microsoft. I just talked about Adobe. We have Salesforce. Salesforce competes against Nice. Well, I imagine these European countries, if they're like, well, if we want to have a countermeasure on the tariffs that the United States is charging us, let's go after software companies. And maybe they start charging Salesforce a tariff. If you sell Salesforce into Europe, we're going to charge you X. Well, Nice is headquartered in Israel, and that means that they could avoid that tariff. Let me double check that. Yeah, Israel. So if they have the advantage geographically to be with a country that isn't in the whole tariff war, maybe they have an advantage. Just one more thing to think about. Obviously, what's most compelling to me is the growth in top line revenue, the profit, free cash flow. They do that, I'm good with nice. It's a good hold for the long term. I think as we see the AI hype continue to lose its intensity, if anything, its volume, uh, you'll see investors go back to these businesses that are just intrinsically valuable, software businesses, really valuable growth companies. The best, most valuable companies are the ones that are growing, that are creating lots of profits, lots of cash, loading it up on the balance sheet. And Nice, I think, is a very good company. So my impression on Nice hasn't changed. It actually got a little bit better because of that story around tariffs. I think the whole tariff war might even help Nice because now maybe companies in Europe are prefer to buy from a company in Israel that is not, they don't want to buy American. I'm in America, right? I love America. I don't want to be in this tariff war, but I'm not the president. I'm just a guy. I'm just a guy that invests his money, tries to make money. So that's what we're dealing with out there. And Nice continues to be, I think, a great business, good stock for today's situation. Tomas, you're welcome on Adobe. What about DISN? So DISN. Disney? Was that Disney, Tomas? So please confirm that, and then I'll continue on. I'll catch up on comments. So thanks so much for joining. I see some comments out there. Let me catch up. And okay, so Box for Fun, Bearlight, Doomy Trash, Sabir, Steve 90, good to see you. You'd like to look at ACAD? Glad to look at it. Just bear with me. It'll take a few minutes to get there. We looked at TLT for Shadow Guy, Tomas. Deckers, I had Deckers and on my list of stocks to look at. It's getting destroyed. We'll look at it because Deckers look good fundamentally because I looked at it, I think on Monday or Tuesday, or maybe last week. And I don't like footwear companies. I don't like apparel companies because their margins are lower. But when I looked at Deckers, their margins are higher than Nike and their fundamentals look really good. And I'm like, man, this thing's nicely discounted. Well, when I show you today's stock price, it's even further discounted. So we'll take a look at Deckers. Android PC gameplay. How you doing, man? Brian Silva, good to see you. Gold is going down. That is surprising. I would think that gold would be going up today. That is a surprise. But here we are. Gold down 2 points. Where's the money going? If it's leaving stocks, we saw that it was going to bonds. Got that. What's going on with crypto? Bitcoin down 4.58. So I guess the money is going into mattresses and stuff. Thanks for bringing that up, Brian. Genetic Smite. How are you, sir? Matthew Price. I found it was interesting to look back at the 1987 crash. It was over in weeks, but took a year to recover. I agree. Yeah, there's a saying that, when stock prices fall, they take the elevator down, and then when they rise, you take the stairs up. It takes a while to climb back up. The elevator will bring you down. Like if you're in a high rise in New York, it is amazing still. I know that they have great stuff, great equipment, but you're like on the 40th floor and you push the button. Literally like 3 seconds later, you're on the first floor. It's like, wow, how did that happen? Well, that's what stocks do. They go down an elevator and then they climb back up using the stairs. What's up, Sergio? What stocks am I buying? Yeah, I'll sprinkle that in as we go over the live stream. So Mike, the dividend invest guy, we covered over nice. Tomas. Yeah, Disney. Okay, you got it. We'll cover Disney. So Shadow Guy question: tariffs shouldn't have any direct effect on SaaS companies like Nice, Adobe, etc. for the time being, but it doesn't keep companies. See, we're not going to charge a big tariff on software companies, let's say, that are coming from China, because we just don't buy a whole lot of software that's developed in China. We don't. But these other countries, I have to imagine they're like, well, what is the US economy built on? Well, big part of it is technology. So they're going to be like, well, we're going to counter with tariffs on technology, software. If you want to sell software in, you name the country, we're going to charge you a 50% tariff on software. Well, that's going to be more expensive. Maybe companies are going to be like, all right, let's pump the brakes on that software project we were going to do and move into Adobe or Salesforce or Microsoft or whatever. And maybe we'll do it next year. Maybe we'll do it the year after. Well, that means that US based software company maybe lost one more incremental customer that would have been a customer, and they went away. I'm imagining software businesses are going to be targeted because that is where the U.S. economy is, really thrives with technology. Good to see you, Rotel and Cheese. Very good to see you. All right, let's get back on Disney. Now, Disney has been an underperformer for some time. Now, going back a few years, they had a CEO. It didn't work out. He was handed a company that was working quite well, and they brought back the previous CEO, and he was handed the keys to this thing that was really working, and he did change some things, like he upset the creative aspects or the creative organizations at Disney, and that was a bad idea because then they were angry at him, or there was tension within Disney, and then they started to really struggle. Now, Disney inherently, I don't think the business is great. There's some pieces to Disney that I think are great, but let's take a look. Sometimes I go into these things and I've got kind of a negative expectation, and I'm surprised. Like Deckers, I went into it the other day and I'm like, I'm not going to like this. And then I looked at it and go, wow, that's a really good company. So let's take a look. $169 billion market cap, 92 billion revenue. So you're paying a little less than 2 times sales. Okay. Forward P looks really good, 17. Analysts say it is discounted. All right. The company is growing. That's very positive. Disney's a big operation. I mean, at their run rate, that's $100 billion operation. They have operations, theme parks, which I think are going to struggle a little bit. And because travel is going down, people are watching their spend, and travel is purely a consumer discretionary item on their household budget. So maybe theme parks see a little bit less attendance, but they have their movie business, and movies do really well during recessions because it's a very affordable way to get entertained. And they also have their streaming service, Disney Plus. And I raised two sons, and I could tell you, man, I spent plenty of money on Disney. Now, on the media, like movies and stuff, and then going to Disneyland. So really had great memories there. I would do it all over again. I've taken my family. I live in California. I live near Disneyland. So we had annual passes. We went there 20 to 50 times. And I also took my family to the one in Florida. And I took my family to the one in France, the Disney in France. So yeah, I guess I've been a pretty good Disney customer. So it's good that they're growing. Very good. That's impressive that they're growing. Now let's get down to free cash flow. Looking good. 8.4 billion. They have their old CEO back, and he's a really good CEO, by the way. Gross margins. This is where I'm like, I'm not in love with Disney. Mickey Mouse, your margins aren't high enough. I just showed Adobe. Adobe's at 89. Disney is at 36. All right. It's just a fact of life. These guys, when you run a theme park, it costs money. It costs money to hire people to run that theme park and so forth. All right. So at $8.4 billion of free cash, they're growing single mid digits. That looks good. We're looking at a recession coming at us, right? So growth is going to be a little tough. So I would multiply, and I need to look at their debt before I do that. So 8.4, and I'm expecting they do have some debt. Let's take a look. Yeah, they have some pretty good debt. $39.8 billion of debt. No, Mickey Mouse. How can you get so much debt? Come on, Mickey. So 39 billion. So I was going to say that I take that 8.4, maybe I multiply it times 10 to 15. That's 84 billion to about 120, 125 billion dollars of value. But then I deduct that debt, 40 billion. I'm down to 80 billion dollars of value at most. And the company is being valued at 169 billion dollars in market cap. Now, I believe that when you have these businesses that are easy for the retail investor and frankly, even these institutional investors to understand, who doesn't understand Disney? Mickey Mouse has been in the American psyche for 100 years. Of course, we have pleasant memories of watching Mickey Mouse, either the cartoons or movies and all that stuff, maybe going to the theme parks and so forth. So businesses like this tend to be popular, but as I'm showing, could be priced at a really big premium. Their margins are really low compared to other industries, like software is 89%. You have other industries that just drive far better profitability and cash. So for me, Disney is a sell. It's been a sell for a long time. I kind of came into the analysis thinking, I don't think I'm going to like Disney. Every time I look at them, I'm like, this isn't the right business for me. I'll continue to be a fan of Disney, and I thank them for the nice memories, but I'm going to go make my money elsewhere where companies have better margins and better cash. So thanks for asking about Disney, Tomas. And hopefully Mickey Mouse is not angry at me for bad mouthing his company. So Shay Nation, are you going to sell Alibaba or add to it? All right, I'll cover that in a little bit. I think we've got a few people waiting, so I'm going to hit those first. Before I do that, let me invite all non-members to become a member of the channel. $10 a month, 25 or 100, depending on the membership you go with. You get a different level of perks, and one of them is you show up to live streams. You go to the front of the line. Second is you can attend as many as you want, but we have 3 investor calls, one on Tuesday mornings, one on Wednesday evenings, and one on Sundays, middle of the day. So you get access to the tools that you see me use. You get access to this content folder and the valuation schedule that I went over on Adobe. You get access to an example. All the valuations I do, I put into a worksheet. You can refer to them throughout the month. I update it once a month, so you can do that. It's, I think, a very good value, and you'll become a more informed, probably improve your skill set around investing by attending these calls and just being a greater participant in this channel. So please consider it. Please sign up. It'd be great to see some of these, especially some of these names that I've seen for, over a year. Become a member. I'd love to hear your voice on these conference calls, and I'd love to see you be more involved. All right, moving on. The markets have opened, and boy, that NASDAQ's looking ugly. Man. NASDAQ is down 16.38% from its high on February 19th. It is down 4.56%. We have the heat map. Oof. Healthcare standing up tall, very tall. Staples standing up nice and tall. Utilities. This is where the safe money is going. McDonald's, Mickey D's. Apple's getting smashed. Meta's getting smashed, man. Oh, man. Amazon's getting smashed. Broadcom smashed. Nvidia, not as bad as Apple. Whew. Brutal day. So let's take a look at the sectors and consumer staples. Number one, utilities, healthcare, holding its own. Technology getting smashed. Discretionary getting smashed. Wow. Amazing. All right. Enough of that. Let's not dwell on obviously a bad situation. Let's get back to these stocks. Let's figure out where we can buy great businesses that are going to be worth a lot more. Then we can look back like we look back at 2022 and realize that was a great time to buy. We had to ignore the noise back then and make good decisions. So that's 2025. Ignore the emotional noise, make good decisions. So somebody asked about Acadia Pharmaceuticals. Down 2.41% year to date. It is down 11.6%. And for the 1 year, 11. High level, big picture, healthcare, I believe, is going to do really well in 2025, even after these tariffs, because tariffs aren't going to affect pharma. And this business, as you can see, is a pretty good representation of the fact that healthcare companies did not rally in 2023 and 2024 with technology stocks and other stocks that really saw its stock prices really go up. So this stock is in a sector that I think is set to do well, continue to do well, and is underappreciated. The market cap is 2.69 billion, revenues 957. So you're paying, let's call it close to 3 times revenue for the company. PE 29, and they don't give us a forward PE. All right. According to analysts, it's discounted by 48%. Acadia, Pharmaceuticals is a biopharmaceutical company focused on the development and commercialization of medicines for central nervous system disorders and rare diseases in the United States. Okay. All right. They are growing very well. Look at that nice growth rate, 32%. Now, the one thing that is concerning, I like looking at the quarterly because these small businesses, they can have like a really boom and then they start slowing down, which is a little bit concerning. Now, what is reality is you see how we're comparing Q4 of 24 versus Q4 of 23. And you see that in the fourth quarter of 2023, the company grew by 69%, which was awesome. And now comparing to that number is a little challenging. Okay, I'll give them that. But it is kind of like, okay, my expectations is it's going to grow by like 10 to 20% going forward. Okay, so good growth company. Free cash flow, they went from negative to positive. Nice. They expanded free cash flows by over $100 million, $140 million to be exact, Nicely done. Very nicely done. Gross margins are expanding as they get bigger. They expand their margins because, they build their infrastructure once and then they can make as much product as they can going forward. That makes sense. Margins are expanding. So this business, the free cash flow is a little harder to forecast because you're like, man, well, is it going to double? I mean, it went up from 16 to 157. That's almost 10x, right? Well, I'm not going to 10x, 157 million. But I would say I could see the business doubling that this year because their scale is getting established. They have good margins. So I would say this business, I would double this number and then multiply times 10. So that'd be 300 times 10 at $3 billion minus debt. And they have a cash surplus of 700 million. So they're actually worth 3.7 billion in my back of the envelope quick analysis. So 3.7 billion, they're at 2.7 billion. It looks discounted. Now, does this look as good as other stocks that I've seen in healthcare? The answer is no. I see other stocks that show better maturity, as good or better valuations, and I would rather buy those. This one here, it looks discounted. But let me show you a few examples of what I'm talking about. So my favorite in this space is Catalyst Pharma. 3 billion. What was the market cap here? 2.7 billion. So we're dealing with about the same value company. All right. And the ACAD wasn't doing nothing for the 1 year, but Catalyst getting it done. Up 52% over the 5 year, up 587%. About the same market cap. Now, the revenue is 500 million, so you're paying 6 times revenue. What was their revenue amount here? Almost $1 billion. So you're getting a bigger revenue company here. This growth looks really good, and it's more consistent. Where you saw ACAD had boom quarters and then fall quarters. Well, for me, that's harder to feel confident about because if you show smoothness, there's confidence. If you show like choppiness, like 1 month is really great and the next month is terrible. Well, what's next month going to look like? It's hard to predict. So these guys have smoother data. They have terrific margins. Look at these margins, 85 versus the other one was, I think, going up to like 60 or a little over 60. So better margins, free cash flow. So Catalyst is a stock that I really like. I also like United Therapeutics. I like Halo. Halo is a stock that I own. There's a lot of good stuff to see in healthcare. I think you're in the right zone here. You're looking at healthcare. Nicely done. I think it's a good place to look for value. You have good choices and pick the one that's best for you. I just shared my comments on ACAD. I think it's discounted, but I like other stocks in the space a little more. All right, let's take a look at Deckers. We'll look at Deckers and Nike. And this guy's getting smashed. It is getting taken out behind the woodshed, getting beat up. Man, 15% drawdown. Owie. So let me show you what I liked. PE low, discounted stock. Growth impressive. Now they guided and they said, hey, we're not feeling confident about the rest of 2025 for good reason. These tariffs. These guys make most of their product in China, in Asia. So if we get into a big, battle, two things will happen. One is it'll be more expensive to import the shoes, and they'll either have to raise prices or they'll have to shrink their margins. Now, what I liked about their margins is their margins are really impressive. 60% for a shoe company. That is impressive because our friends at Nike, of course, we all know what Nike is. Nike's bigger, it's not growing, and the margins. They're 44% margins, where Deckers is way up there at 60. Impressive. And this is a smaller cap. So they have very good margins. They have good cash flow. They have good growth. Now they've been discounted. So if I multiply, and let's take a look at their debt, because I'm thinking, let me take a look at their debt. So they have 2.24 billion in cash, 2.57 million or 257 million in debt. So they have basically $2 billion of cash just sitting on that balance sheet, ready to deploy. Well, at their growth rate, it is an impressive growth rate, right? Good margins. So I take cash, $1 billion times 20 plus the cash, I get to $22 billion in value, but they're being priced at 15 billion. So this one here was actually a stock that impressed me. And I actually think, I'm thinking I'm going to analyze this stock further and possibly buy. Now, do we know how long these tariffs are going to last? I don't. And I don't think anybody knows. And I would not be shocked if in like 2 weeks or a month, okay, everything's been resolved. We're back to, tariffs that were similar to what we had before. It might take a year. But Deckers is a business. Their brands, like the shoes that they sell, are very popular. And I think it's not the biggest stock in the world. $15 billion market cap. It's not bad at all. So this one's showing me a lot. One of the things that, I've been studying these super investors and they influence me. And I studied Howard Marks most recently. I released a video yesterday. And that guy's buying into all kinds of like unique companies. Unique's the wrong word. All kinds of companies that are far outside the mainstream, like Apple and Microsoft. Of course, everybody knows what those are, but Howard Marks is buying these obscure names and even going outside the US. And then the great Michael Burry, the guy's into apparel companies. He owns Canadian Goose or Canada Goose. I'm like, what's the big short guy doing buying an apparel company? And somebody did comment this just to remind me. He's like, he does, I'm sure, recognize that some companies are worth more than others. Some industries are more valuable than others, but he's looking for highly discounted stocks. And I would say Howard Marks very much committed to that. It's not about what you buy. It's what you paid for it, is what Howard Marks would say. So if I'm getting a superb discount on Deckers, maybe Howard Marks making an impression. And if you haven't studied Howard Marks, Michael Burry, Pat Dorsey, study those guys. And of course, Warren Buffett. But Warren is like, he's awesome. Love Warren Buffett. But I think when you study Pat Dorsey is incredibly generous with sharing his strategy. He shares a freaking PowerPoint on his website. He tells you what his investing strategy is. He goes through the steps. It's like logical. And Howard Marks, not quite to the level of detail that Pat Dorsey will provide. And Pat Dorsey shares his philosophy. Pat Dorsey's awesome. Pat Dorsey's crushing the market this year. He crushed it last year. He crushed it the year before. He just crushes the market. He's really good. Howard Marks has great words of wisdom. As I look at his portfolio, I'm not seeing an outperformance kind of portfolio, but the respect is like can't get any higher for Howard Marks. I think he has some things to say that should be in our minds as investors. I think we'll make more money if we listen to Howard Marks, Warren Buffett, Michael Burry, Pat Dorsey. Those guys, and Michael Burry is pretty quiet and silent and kept to himself. So there's not a lot to learn there. But Pat Dorsey, Howard Marks, those guys are very, very generous with how they do things, why they do things, and we can learn a lot from those guys. So, all right. So Deckers, getting a little star next to that name on my little sheet of paper here. I find really good stocks through this process, guys. I'm not going to lie. I've found some winners doing these live streams. So I appreciate you bringing up Deckers. We beat it up a little bit. The next one on the board is Alibaba. Baba's been a good stock in my portfolio. And the question was, am I going to sell? Am I going to buy? It's holding it together, folks. I mean, look at Nike. It's down 12%. What's going on with Apple? It's down 9%. Alibaba, holding it together. You know, the rest of my portfolio is probably going to be, other than my bond portfolio, right? And my staples like Kroger is probably going to be doing well. I'm holding. And would I buy some shares today? Potentially. I'm a buyer of Alibaba. I own a lot of Alibaba stock. Okay. So I've been doing great with Alibaba. So I think it's number one stock in my portfolio. It's Alibaba and then Robinhood. But Robinhood, I know, is getting shellacked this morning. It's getting beat up. So the answer to your question is I'm a buyer of Alibaba. I'll show you my valuation of Alibaba based on free cash flows. It's a very valuable business. Based on cash, and I use a higher discount rate than comparing it to Amazon because Amazon is in the US. Alibaba is in China. Higher risk to me, but it's still discounted by 40% when I look at cash flows. So Alibaba within the region of Asia is going to be the dominant e-commerce player. And they have come out with their AI model, their large language model. It looks impressive. So a lot of good things happening with Alibaba. Their fundamentals show a really nicely discounted company. I'm glad I own the shares. I'm a buyer of Alibaba. I would not be selling one share of my Alibaba stock. I wouldn't sell any of my Amazon stock. I'm not selling any of my Mercado Libre stock. I'm a buyer of all three. And if the market wants to give me a huge discount, I will gladly take it. So that is Alibaba. Thanks for asking. All right. So let's take a look at these. Let's look at the comments here. Comments are coming in volume now. Okay. Android PC. Thanks for showing up. Brandon YMD. Are you really a doctor, sir? So I'd like to see your analysis on Rhine Metal ADR, ticker RM. Okay. We'll put that on the list. RNMBY. Brian Silva. Very curious to see tariffed countries' response. Yeah, we'll see how that plays out. I think it's going to be noisy in the press. But again, I'm separating noise from detailed information. Like I need information. I don't need more noise. Investing's hard enough. I don't need to get caught up on tick for tack stories and all that stuff. Cool, Steve 90. You're also a Catalyst. Very good, man. I'm glad you're a Catalyst stockholder. That one's been doing well. Catalyst is a winner for 2025. So far, so good. Brian Silva. Baba's almost in the green. Exactly. Good morning. Ozic. Very good to see you this morning. Paul, good to see you. RH. Let's take a look. Oh, Restoration Hardware announced their earnings, and they're getting beat up. Let's take a look at that one. Good to see you, Paul. And let me catch up on comments. Brandon, I worry about the U.S. making it illegal to own Chinese stocks with this trade war possibly escalating. Yeah, I don't know if the U.S. is going to do that. But I can understand the concern. Tomas, Mercado Libre. Nice. Take a peek at Mercado Libre. And then James Sketcher, Google and Uber. Yeah, we can take a look at those. Those are good to look at because how will tariffs impact Google? How will tariffs impact Uber? So let's take a look. All right, good stuff. Just a quick reminder, 2 ways you can sponsor this channel. You can join. You can become a monthly paid member of the channel. You go to my homepage. It's should be easy to get to. You just go on my channel homepage and you join. And you get some perks along with that. The perks are listed out. When you click this button, it'll show you the perks. I think they're very worth it. And the other way is you can buy a super chat on this stream. You're like, you know what? Don't want to be like reoccurring member, but you know what? I'll throw a few bucks at you. And can you analyze this stock? So think about that. Think about your options there. Sponsor your channel. Or sponsor the channel if you can. All right. So let's take a look at the heat map. It is glowing red. It is a Christmas again. What is all the red on the screen all about? Man, I am not going to like. So Meta is my biggest position. It's going to hurt to look at the loss today. And better get some tissue ready when I look at my Meta stock. And then Google's my second biggest position. So it's going to be a day that is going to take a little bit of emotional support from my family. We'll see. All kidding aside, I'm probably going to buy some Meta stock today. I'm probably going to buy some Google stock today. Thanks for the discount. I'm probably going to buy some Amazon. I'm going to analyze NVIDIA soon, man. This is getting really low. I'm beginning to think that semiconductor is beginning to look really good. We saw a semiconductor company. Did we see it yesterday? And I started thinking I wanted to buy that semiconductor company. And I actually had a buy order and I canceled it because I'm like, whoa, once the tariffs came out, I put it in. It was active last night. I canceled it, and we'll have to revisit that trade today. I'm probably going to buy that little company. Semiconductor keeps getting more attractive after having a couple years where it just boomed and it got euphoric. But if you look at the last 6 months, these businesses have been losing a lot of market cap. Well, at a certain point, the market tends to oversell, and I'm trying to invest at the right times. So I'm going to look at semiconductors, see if there's a good time to buy. This is causing a good part of the index losing value because this is the most valuable company in the index. Interesting. And here it is. So healthcare sticking out like a green light. And here we go. Consumer staples, utilities. Remember, I said that real estate's probably going to do well because lower interest rates. You see that here. So that's what's going on out there. Let's get back on these stocks. Next one up is Restoration Hardware. We're going to go over the member request, and then we're going to hit the free request. Let's take a look at RH, Restoration Hardware. These guys are a premium retailer, home furnishings and stuff like that. Now, these guys, for 2 reasons, are going to really struggle. One is the consumer is going to scale back their spend. Second, these guys, most of their stuff's made in China. So they're going to get higher tariffs. 42% drawdown in one day. $2.65 billion market cap. Oh man, look at that. Wow. Man. I thought I was going to see stock prices go down today, but this is really, really something. So from the top, the top was January 21st to where we're at now. Stock's down 68%. So that's from January to April. So less than 3 months. Not a pretty sight. But is it now an opportunity? Is the market just a little too angry, emotional, ticked off, confused? Let's take a look. You're paying less than 1x sales. Forward P is 12. Analysts, based on their previous price targets, this stock's really discounted. So I see a little green on the growth, and they have been growing nicely. Now, previously, you already saw it. They were struggling to grow. Okay. They started to grow again, but I'm thinking, man, I think a big part of this growth back in the COVID days is for two reasons. One, people were at home, so they wanted to make their homes nicer. Totally, I get it. Hey, I used to go into an office to go to work. Now I Zoom all my meetings, and I'm at home a lot more. So I want to make my home a little nicer. So you go to Restoration Hardware and buy some nice stuff. Second, the government was sending out stimulus checks. Hey, here's some free money. Hey, thanks for the free money. I'm going to go buy something that I wouldn't usually buy with my hard-earned money. But this easy, I never didn't earn it money, I'll go spend it at Restoration Hardware. So there's some stimulus money. There's some work at home money, and so forth. So, all right, moving on. So they are growing a little bit, but I can't believe they're going to grow going forward for a couple of reasons. They're burning cash. Not good. Not good at all. And they announced their quarter yesterday. And look at that. They grew. Looks good. Free cash flow is negative. Why are you guys burning cash? Yeah. Retail's tough, man. You got to hire people. You got to rent out, lease out, expensive real estate. It's not my favorite industry. And so they're burning cash. Got that. Gross margins, 44%. It's not bad. Okay. So these guys see this. They were generating cash. Probably in 2022 was when these guys were super hot. And this is a Jim Cramer special. He was so hot on Restoration Hardware. Oh, Restoration Hardware is great. This is a Jim Cramer special right here. And the business, you got to understand what industry you're investing in and what the attributes of that business are. Lower margins, lower cash flow. Just retail's tough, man. It's really, really tough. So is it a giant surprise that they're now burning cash? No. I could understand it. They might be writing off inventory. It's just there's a lot of challenges there. This one's a sell. This is a dumpster fire. And could this thing recover? Most definitely. See, this is the COVID era. Everybody's buying stuff for their house. And Restoration, Jim Cramer is pumping this stock. Yeah, man, this is the greatest stock. And then slam. And now double slam. So no thanks. Yeah, this isn't the right investment for me. It's a sell all day long. Decker's a different animal. Like, they have really good numbers. They're growing. Cash on the balance sheet. I didn't even look at their cash and debt balance. I didn't even get that far. They have debt. They have $4 billion of debt. So not only are you burning cash, you got debt. Good luck with that. So I'm staying out of Restoration Hardware. Jim Cramer. I don't don't invest in many stocks that dude believes in, but I do listen to him. I do think that from a sentiment perspective, he does have a good read on what the market's thinking. And that I like hearing that, by the way. So I'm not a complete hater on Jim Cramer. Mercado Libre. Let's talk about e-commerce. 4 Latin American countries that are buying stuff off this website, holding its value, down 1.22%. I'm going to snatch up some Mercado Libre today. I will gladly buy. I've been buying into this stock. I think that they have a good forward plan. They're getting a lot of their stuff that goes on this site from China. So it's not like these tariffs are going to affect them. It's like, okay, these guys are outside that tariff issue. So that's another reason to buy Mercado Libre is, hey, the Mercado Libre is headquartered in Uruguay, and they do a lot of business in Brazil, Mexico, Colombia, Uruguay, Argentina. So those countries are not going to be like all mad at each other. Like, I don't think Brazil's mad at China, and I don't think Mexico's mad at China, and vice versa. So those countries are going to be like, hey, well, we'll get all our stuff, direct from China, no tariffs, all that good stuff. So we'll see how that plays out. But I'm a buyer of Mercado Libre. And when I look at their value, I think I have it near here. I thought I did. Guess I'm going to have to do a search for Mercado Libre. There it is. Based on cash, these guys have a heavy, beautiful discount of 100%. Boom, boom. Love that 100%. And I'll keep snatching up shares. And it shows that, my logic of these guys are not going to be impacted by tariffs. I think investors are recognizing that. The stock's only down 1% when our friends at Amazon are down 8%. Boom. Howie. Look at that slide. Whew. But hey, looks like a good stock to buy to me, man. Amazon is just going to keep getting more powerful, more valuable, more important. Stock market wants to sell it off. It's a discount. It's a discount on a really good company. So I'm a buyer of Mercado Libre, buyer of Amazon, buyer of Baba. Let's take a look at RNMBY. So Rheinmetall AG, Germany, founded 1889. Oh, right. Aerospace and defense. Now this space has been rocking. So they do mobility and security technologies worldwide. So I think in Europe, those guys are going to be tighter partners, like Germany, England, France, Italy, Spain, all those countries are going to get, their relationship's going to get tighter because I think the U.S. is really creating a lot of tension between U.S. and those countries. So they're going to try to, gather themselves and have a tighter relationship. And the reason I bring that up is I think this company will have advantages selling within Europe. And an American company that would compete against these guys in Europe is going to have a disadvantage. So, and of course, Europe can import stuff from China. I don't think that's changed. And again, the U.S. is kind of creating tension around the world, but the rest of the world may say, hey, China relationship with Europe is probably going to get better. China relationship with Latin America, better, and so forth and so on. So I know that the administration in the U.S. is trying to do something to bring back manufacturing to the U.S. and make these changes. And I would like the president to be successful. If he intends on making the US better and making the lives of Americans better, I'm all for it. But I also have to call out what's it going to do internationally. And you see this company's going up. That's probably because, hey, they probably just became more preferred by customers in Europe, maybe customers in Asia that are like, we don't want to buy from the US as much anymore. We want to buy from companies out of Germany and Latin America. Maybe they're like, hey, you're putting more tariffs on us. We're going to look for sources in Europe, especially Germany. So this stock has really been working. The 1 year 168. Wow. Year to date 136. Market cap 61 billion. Are we dealing with US? Yeah, US currency. You're paying 6 times revenue. PE is 82. So they're growing nicely, 36%. Very nice growth. Very nice. Now, if they're like other aerospace and defense companies, the margins are very low. And this one is higher. So they're more of a software kind of intellectual property kind of company. 52% is very high. Like if you look at like other like plane manufacturers, those types of defense contractors, they're like 15% margins, really low. All right. So 52% margins look good. Free cash flow looks good. It's grown really well. But at best, that can go 20, 30 times this amount, which would get us to 20 to 30 billion dollars minus debt. And they have $1 billion in debt. So 20 to 30 billion dollars of value, and they're way up there at 61. And the reason for it is, I mean, the stock's really up, right? Are they going to grow into this valuation? Potentially, but I don't make money. Howard Marks, right? He didn't make his billions. The guy's worth billions. He didn't make money buying the right stocks. He made his billions by buying at the right price. And if you look at Pat Dorsey, he has a similar philosophy, which is you want to calculate intrinsic value and you want to buy below that intrinsic value. We're not going to be doing that with Ryan Metal. They're doing great. Good for them. Good for their employees. Good for stockholders that have owned the stock for a couple of years. But it's not good for me that I would be buying shares. I'm not going to buy shares. I wouldn't be a buyer. I'd be a seller. If the stock were to one or two things would change my opinion. If they just grow their revenue and they start growing so much that it changes the valuation. But you know, that's harder to do. Or you have a stock price correct. Like if it came down to half its current stock price, maybe it becomes interesting. But for now, I would be buying at a premium. That is a no-go for me. Thanks for asking. Interesting company. Interesting to see that we are seeing green on the screen with a company in Germany. Really interesting. All right, so let's move on. Let's hit some Google. Somebody asked about Google Alphabet. It's down 3.34%. How will the tariffs affect Google? I don't think it's going to affect them very much. Google, the search business, how do you charge a tariff on search? That'd be a tricky one. And then their next business, YouTube. You can watch YouTube videos for free. Well, if you charge a 50% tariff on zero, you get back to zero. So that's tariff free, or it doesn't get affected. And then we've got their cloud business. Now their cloud services, I'm going to say, are mostly for domestic consumption. Their cloud services are mostly for US companies, but they are growing in Europe. That might be a headwind because European countries may be like, yeah, we're like not liking American companies right now. Possibly, but their two main competitors are AWS, Amazon, and then Microsoft with Azure. So their main competitors are in the same boat. It's not like, hey, Europe is like, we're mad at the US, so we don't want to buy from American hyperscalers. Yeah, but what's your other choice? You don't have another choice. Maybe they go to Alibaba and they go, Alibaba, we want to use your cloud. And Alibaba wins out. Maybe because Alibaba does have a hyperscale business. I like Google. Strategically, really good company. Products are great. It's getting discounted. It's a buy. I ran the numbers. Google has not gone up as well as its counterparts. It has spent more cash on the data center. So that's been a big problem in my mind. Fingers crossed at the earnings that they announced in roughly 3 weeks, they're going to say we're not going to spend as much capex, and that's going to improve their valuation. But in general, their earnings per share look fabulous, and it's a discounted stock. And this is Google. This is gold standard. There's a couple stocks that are gold standards. Google's one of them. I'm a buyer of Google. Market's selling it off, but not as much as other stocks. Uber is an interesting stock to look at. How will tariffs affect Uber? I think they get to avoid all that noise, but they're down 5%. I will buy shares of Uber. How will tariffs affect them? I don't know. I mean, all the services are somewhat localized because they're the platform where when a rider wants to fetch a ride, they use the Uber app. Somebody picks them up, and so I don't think tariffs are going to affect Uber a whole lot, but the stock has been growing. Cash flows look beautiful. They have the autonomous driving robo-taxi threat is really overdone. I think Uber is going to capitalize on that as an opportunity. So when I look at Uber and I look at the value of Uber, it's a really, really good value. Based on discounts, discounted about 112%. What's there not to like about that kind of discount? And mainly why it's discounted is the whole threatening story that, well, robo-taxi is going to take Uber's business away. I don't believe that's going to happen. I cringe at the thought that most cities are just going to be a bunch of robots driving people around. I think we're going to ease into it. Waymo's doing a nice job. Waymo's the leader in robo-taxi so far, and Waymo's a Google company. And as we get comfortable and confident behind those technologies, then we're going to continue to expand it. That is logical in my mind. But Waymo is a big money loser for Google. That's another thing that you have to recognize. And I think if companies like Tesla embark on robotaxi, it's going to be substantial losses for a couple of years until they figure it out, and then it becomes potentially a profitable endeavor if it ever does. So I think Uber is fine, and I think it's a good buy for me. So I'm going to be buying some Uber shares. Lots of stuff on sale today. All right, we're covering a lot of ground. Let's take a peek in general at the markets. I know it's kind of a bad situation. Here we are. Well, NVIDIA, I think, got a little better. Apple got a little better. We're mounting a recovery. We're mounting a rebound. Look at the health plans. Looks good. Pharma looks okay. Staples. And the sectors. Let's take a look at these sectors. What's going on, sectors? Only one in the green, Staples. Everybody else, take your medicine. Discretionary is just getting destroyed. Technology getting shellacked. Energy is getting banged up. Industrials. Wow. Interesting. Whew. What a day. What a day. Ha. All right, let's get back into it. Bushi 1147. How are you, sir? Jim Cramer strikes again. Wayfair. I haven't looked at Wayfair in a long time. Let's take a look. Brian Silva, can you look at PayPal? And I think international brokers, that brokerage. And Tomas, how will they implement self-driving cars in cities with high rates of crime? See, that's what I'm talking about when these AI stories, right? It just becomes silly at times. They're like, oh yeah, it's just gonna go flawlessly. And you think of that, and then so crime, and then I'm gonna give you a different thing to think about. So you're right, crime. Let's say somebody hails a ride, and I don't know, they steal something out of the car, they vandalize, or they see somebody hail an autonomous driving car. I don't know. So crime is an issue. But the other one is, let's say for whatever reason, one of the riders um, uh, dirties the car, soils the car. Maybe they had too much to drink and they vomit. Maybe there was a little kid in the back seat and they have an upset stomach and they vomit, or whatever caused a soiling of that back seat. Well, the next rider shows up and they're like, I'm not going to ride in that. And they report on the app, your car is like really dirty and there's no way I can drive in that. And I want to cancel this ride and it's a bad impression. Well, that car immediately is going to drive itself to whatever hub it belongs to. Somebody's going to clean that car and then you can put it back into service. That's something that's already happening. And it's a money losing situation for Waymo or whoever does robotaxi, because the time and the cost and the manpower to clean that car. And let's face it, when you have a human being in the front seat, maybe there was an accident, that person is driving a young family and a little boy or a little girl, has an upset stomach. I mean, I've been in hundreds of Uber rides, and I would say that Uber drivers are super cool. That person is going to be like, yeah, don't worry about it. And they're going to have cleaner in their trunk and they're going to clean that back seat and they're going to be back ready to serve the next customer in 10, 15 minutes. And that back seat's going to be fine. But when you don't have a human being in the game, in the whole car's got to drive itself back all the way back to its hub, get cleaned, and then it goes back into service. So there's a lot of little details that need to be sorted out, and they're going to have to sort them out. How will they cover that? The one thing I would say is, like in Los Angeles, there was a idea, and I think it's been a money losing idea ever since, where you have all these scooters that people could just walk up to, and you have an account with Lime, or I think Uber had it too. And you rent this scooter, and you rent it by every 5-minute increments or something. And maybe you pay $5 to take a scooter, a mile. And, oh, that's great. You don't have to have any person managing the scooters. They just kind of get rented. Yeah, it's fine, except people started vandalizing them. In LA, Santa Monica, where they were throwing them off the pier into the water. That's a big loser. They were getting damaged. They were getting put in awkward places. It's just, big city problems. So when you have robo-taxis, I think there's a lot that will need to be figured out. I do believe that robo-taxis have a future. I have no problem with robo-taxis. I just don't think they're going to dominate in the next 5 years. Maybe in 10 years, it's going to be a substantial amount of the driving. Maybe. But that's if all things go well. Shadow Guy. Automatic flamethrowers. I'm trying to think of the context. Oh, so for AI or anyway, so Wayfair. So Wayfair for a little while I thought was doing some things right. Let's see what's going on. And it was really doing well. Like back to COVID, right? People wanted to make their homes nicer. They went to Wayfair, they bought furniture, they got nice stuff for their homes, and then the stock collapsed. Because I think they probably had a catalog that was pretty attractive to the consumer, and entrepreneurs that sell on Amazon copied their catalog and said, "Hey, I'm going to beat Wayfair on price," or however they were more competitive. And market cap's 3 billion. Let's see if this is a decent buy. 44 forward PE. Financials. They're stabilizing their business quarterly, growing a little bit. All right. So these guys are an e-commerce company. If you're not familiar, they're kind of a niche kind of e-commerce company, but the biggest worry I have is what's going on with your revenue. Why is it not growing? You see that they grew here, then they hit a wall, and it looks like Amazon, Alibaba started to really hurt them. Free cash flow 244, and margins are at 30%. Okay. So 244, do they have any debt? Yeah, they have about 3 billion of debt. So that's a problem. So 244. Yeah, these guys are uninvestable for me. 244 of free cash, even if I multiplied it times 20, I'd get to like 4.8 billion minus the debt, which is at 3 billion, right? I get back down below $2 billion of debt of value. This is uninvestable. Debt is really, really bad for businesses that are this small. These guys have $3 billion of debt, and the market cap's 3 billion. So really, investors are like, the company market cap is really 6 billion, because if you wanted to buy the company outright, you write a check to stockholders for 3 billion. Then you have to write another check to the banks or whoever lent the money for the other 3 billion. And the free cash flows are nowhere near the intrinsic value of $6 billion. At best, they're like $2.43 billion of value. So this one's a complete pass. Sell, sell, sell. And it's down 29% today. Even though it's down 29% today, it is not a buy. This is just it's a dumpster fire, but it's Wayfair. So the dumpster has like nice little flowers on it. It's a pretty dumpster, but it's still a fire inside of it. It's not like one of those trashy behind a restaurant kind of dumpsters. All right, PayPal. So how's PayPal gonna get through these tariffs? Oh man, down 8.47. Well, they're not going to directly be hit with a tariff, but I have to admit that PayPal is probably going to see some of its volumes go down, because PayPal is a very popular way for people to pay online. And of course, people can pay each other on PayPal. You have the Venmo app. But I don't think they're going to be hit as bad as, let's say, an Amazon or, a retailer that imports a lot of goods. So that sell-off of 8.5 is probably overdone. The PayPal business, $60 billion business. They are growing. They are profitable. They do generate great free cash. Awesome free cash. Look at that free cash flow growth. Okay. And margins are decent. They're financial services, so they have to put their margins are lower because competition. They can't price themselves out, because then other alternatives for payment would come in and take their business. The margins have been coming down. I think that's what's been on investors' minds is why are these margins coming down? That is a logical concern. I agree with it. Now, balance sheet, they have net $1 billion of debt. $1 billion on a $60 billion market cap company that produces $32 billion of revenue. $1 billion isn't all that much. When I look at the stock and I do a valuation on the stock, I get a really nice discount. I'm up on my PayPal stock. I'm doing well because those cash flows are just so darn valuable. The intrinsic value of those cash flows are way up here and the stock price is way down here. So I'm going to buy some PayPal stock today. It is a buy. I am buying PayPal stock. I think I'm going to wake up in a year or two and I'm going to have a double. This stock price is going to double in value because it's just so darn valuable of a company. They keep growing and they're pretty much institutionalized into a lot of different industries. Venmo is a really nice growth application. So I'm good with PayPal. I think it's a good opportunity for me. IBKR. Interactive Brokers. And these guys are probably getting beat up because there's a big sell-off going on. Okay. Over the year to date, down. Over the 1 year, up 40%. That looks nice. And over the 5 year, awesome return. Great. Nicely done. 17.5. Revenue 15. Very decent. Forward P 21. They have been growing very nicely. Look at that growth. Nicely done. They produce great cash. Look at that cash. 8.6 billion. Man, that looks great. This stock is severely discounted. Net cash, 65 billion bucks. And this may be some account holder cash being included. So I'd have to go directly to the financials of Interactive Brokers to make sure I was just counting the cash that should be counted. This is discounted. I own Robinhood for the same reasons. I'm going to put a little star next to Interactive Brokers. Right now, the brokerages are going to sell off because if we have a prolonged sell-off in a really bad bear market, investors don't like buying. They're like, oh my God, I'm losing. Look at my portfolio. I've lost 20% year to date. That really hurts. I don't want to make any more decisions. I feel so bad about it. That's the psychology of a lot of investors. That's not the psychology I would encourage you to follow. What I'm going to do is I'm going to keep my wits and I'm going to keep thinking and I'm going to keep moving. And I know that making good decisions right now are going to pay off. But most investors don't operate that way. Now, if trade volumes go down, revenues go down for Interactive Brokers, revenues go down for Robinhood, and that's going to show up. So is it logical for the stock to be priced down 8%? Yes. But are these guys discounted to begin with? I believe so. I think this is a really good opportunity. I like Robinhood. I don't like buying too many of the same stocks. And I did look at Interactive Brokers before I bought Robinhood. This one's doing okay for year to date, but for the 1 year, it's doing great. So I bought Robinhood at the right time. I'm sitting on a nice gain for the same reasons. Interactive Brokers and Robinhood are kind of in the same, game, and they have similar fundamentals. But I'm going to look at Interactive Brokers. Maybe that's a second stock I can add. For sure, Robinhood, at down 12%. Wow, that's brutal. Man, my portfolio is not going to look good. Maybe I should just not look at it today and just buy stocks and Just don't look at it. It's going to be too much of an emotional impact. All right. We went over, man, we've gone over a lot of stocks, everybody. That's great. All right. So let's get back on these comments. I can go at like another 10 minutes. So let's see how far we can get in that time. So Sabir, you like Wayfair long term. I shared my comments on that. Brian, I went over PayPal and Interactive Brokers. Okay, so Shadow Guy. Scooters are very popular in Zurich. Yeah. So, yeah, if you have everybody following the same rules, I think it'll work. Los Angeles, not everybody follows follows the rules. Yep. So Brandon with metals, all-time highs, oil relatively low. You know, I think gold miners is not a bad idea. Gold, copper, zinc, and the precious metals, it's not a bad idea right now. I think those commodities are going to continue to go up in price. And as those prices go up, the miners make more money. I'm buying into materials, and that's the sector they belong to. I think that's a good idea. I'm buying Hood. So Tuner iOS, I am buying Hood at these prices. Yes. Mike, the dividend investor guy, lost power, wasn't able to get back. What stocks were we showing to buy? Let's go over. Let's recap. Well, the one stock that caught my attention, Mike, is Deckers Outdoor, and it's down a lot today. But I think I was surprised last time I looked at it. I think I looked at it a week ago as to how good the fundamentals look. So I'm going to look at that one a little closer. Adobe was a buy. Mercado Libre was a buy. Baba was a buy. PayPal buy. Interactive Brokers look like a really good buy. Google buy. Uber buy. The ones that were sells was RMBY, sell because the price is too high. Wayfair, dumpster fire. I would not touch that stock. I don't remember about ACAD. Sorry. I think it was pharma, and there's just better choices than ACAD, like Catalyst and others that we've gone over. Restoration Hardware was down 42%. And it's, oh man, not a good day, but it's kind of a dumpster fire. I'm staying away from it. That's a recap, buddy. All right. So Zim. Oh, my intuition was that, man, Zim's going to get hammered today. And I stayed away from Zim, 14.6%. And ever since they announced they had their ex-dividend date for pass, I guess, this stock's just gotten hammered. Now, the big picture situation is, is there going to be more voyages for more trade? I don't think there's going to be a significant drop, but there'll be a drop. And if those rates drop, I think it's going to be a headwind for Zim. If it's getting sold off this hard, it might be a buy just because, I think last time I bought Zim, it was like down here. So I made out really well. If it got below $10, I could not resist a stock. But it's going to take a little bit to get below $10. I bought here and I sold somewhere like here. I bought sold at $20 a share. So I did really well. But I don't know that we're going to have Zim get down below 10. If it does, I'd probably buy. But it's just, there's so many unknowns with Zim. I wouldn't want to touch it. You have a buy at $10. Go, Mike. Yeah. So you remember looking at Deckers. I do too. And that was one that I kind of started looking at it. And my analysis a week ago where I was, negative attitude, like, I don't think I'm going to like this. And I looked at all the numbers and I'm like, this looks really good. This looks like a good company. So it kind of turned me around. All right, cool. All right. So that was a really good stream, everybody. It's going to be a rough day. So just hang in there. It might be a rough couple months. It might be a rough 12 months, but I assure you this market will rise. It will rise over the long haul. And we just got to get some of these negative stories out of the system. Look at that. The 1 year on the NASDAQ is only up 2%. If we go back like 3 months ago, it was up like 25%, 30%. And now, bam, it's really dropped. It's down 17%. Wow. Incredible. And the S&P is back into correction, 11.66%. So the S&P in 2022 was down 25%. So we are about 40% there compared to 2022. So it could keep just dropping. Now the drop has happened really fast. It's been very clear that the market does not like certain things. All right. So that is the stream for today, everybody. Thanks for tuning in. Really appreciate it. Please consider being a paid member, sponsor the channel, support the channel. I'd really appreciate that. And I hope you do it. I hope you do it. Everybody, good luck out there. Remember, keep your wits. Let's just keep making good decisions. You will make a lot of money if you make good decisions. But, getting discouraged, don't buy into a lot of these stories that are coming out. Try to separate facts that are useful from just a bunch of stories just on a loop to get everybody's attention because things are tough. Let's keep getting on these streams, keep looking at these companies, keep finding good companies. And just remember, I never recommend you buy, hold, or sell any stock. It's always your decision. I'm just sharing my point of view. I hope you find it interesting. And I wish you the best of success in it. I'm sure that a year, 2 years, 3 years later, we're going to be look back and go, wow, those were really good prices back then. And that's how I'm going to view it. All right, everybody. Have a good day. Take care.